Okay guys, welcome back to the channel. So in today's video, I want to give you guys at least my perspective on the broad state of the market at the current moment. So if we take a look at my portfolio, we all know that over the past month, the market has been doing fantastic. We can see that my portfolio is up nearly 10% in the past 30 days with 150 bucks of dividends. And taking a look at the S&P 500 directly, since the June lows, there has been a significant and rather fast rebound in the market. And this might signal to a lot of people that the pain and bear market is over and it's time to start investing. But according to other people, this is a bear market rally and we still have more downside to go. Most investors, economists, see Fed rate hikes causing a recession within 1 year. To be more specific, it's 63% of the people in this survey, and they put a 55% chance on a recession in the next 12 months. Now, to understand why this is the case, I went ahead and kind of crudely wrote down how I see the current state of the market. So let's begin with the white section here, the current situation. So, of course, the big issue of the day is the high levels of inflation. This data right here is the primary reason the stock market is going through all this turbulence so far in 2022. Now, the most recent reading of inflation was actually pretty good at a modest 8.5%. Now, that's still a very high figure, but the reason why this is viewed as a positive is because it breaks the upwards trend, and it seems like we may have peaked back in June and might eventually begin to cool off a little bit. Now, to back up a little bit, the whole reason why we have this historic inflation is because of strong demand from the consumer. So the consumer confidence is pretty high in the economy right now, and it's thought that a big reason for that is all of the COVID stimulus and all that extra money that was printed and added into the system. And when you couple that with the supply chain limitations we currently have due to shutdowns, the war in Ukraine, those things together is what produced the high levels of inflation that we see. Now, the second part is in blue here, and this is the Fed's response to the inflation, because the inflation itself isn't what's causing a recession in the market. It's how the Fed is responding to this, and their primary tool is quantitative tightening, aka raising interest rates and making money more expensive within the economy. And the point of this is to soften the demand and cool down the economy on purpose to fight inflation. And coming back up to the white section here, that's going to directly affect the demand and bring that down a little bit to more reasonable levels. And the second part of the supply chain challenges, of course, the Fed can't directly do anything about this, but hopefully by softening demand, the supply chains will have time to catch up, commodity prices will go down, and that further fights inflation. So that's all pretty basic stuff, but the final point here is why primarily the stock market has been so volatile over the past couple of months. So the Fed, of course, is trying to slow down the economy to fight inflation, but at the same time, they don't want to cause a massive unnecessary recession. And that's what's known as the soft landing, and it's what the Fed is trying to accomplish. Okay, so that's a high-level overview of the entire market. Now let's take a look at some data. So I thought this is pretty interesting. In blue here is the S&P 500 spanning back all the way to 1980, and these red vertical bars are the US federal funds rate. We can see that back in the 80s, the rate was over 16%, the highest in history. And then in the 2010s, it was near zero. Of course, back in 2020, in response to the pandemic and to help stimulate the economy, the rates were cut. And now to help slow down the economy, rates are increasing once more. But overall, you can see the balancing act that the Fed tries to do here. So when the stock market gets really hot, they start to raise interest rates to cool it down, prevent bubbles. And when the market needs some help, they cut the interest rates to help spur growth and investment. So with interest rates on the rise, that's why so many people are afraid of a recession looming on the horizon. And especially with the most recent data coming out, we had 2 back-to-back quarters of GDP decline. So technically we are in a recession, but luckily other metrics are still pretty healthy looking, like the unemployment rate. We're currently sitting at 3.5%, which is some of the lowest on record. And this, of course, is the federal funds rate, and we can see all of the rate hikes that have been happening so far in 2022. And looking into the future, it looks like we're going to have roughly a 3% rate by the end of this year. By the end of 2022, it's going to be over 3%. It should peak sometime in 2023, and then in 2024 begin to come back down again. But keep in mind, this is all contingent on the economic data we continue to receive. So best case scenario, the inflation rate continues to drop faster than expected, and in such a scenario, then the federal funds rate doesn't need to climb quite as fast and aggressively as previously assessed, and that would be great news for the stock market. But of course, on the flip side, inflation could remain stubbornly high, causing the Fed to more aggressively raise interest rates, and that in turn could cause a greater recession in the economy. So depending on your beliefs and which side of the argument you fall on, that's going to dictate whether or not you're bullish or bearish on the current state of the stock market. If you want my opinion, I think this rebound we're seeing isn't a great time to pile into stocks. There's a very high likelihood that we roll over at least somewhat. But I have to say, long term, I am pretty optimistic that we can avoid the worst case scenario, and ultimately stocks can perform pretty well over the next couple of years. But definitely let me know your thoughts in the comments down below. If you're still watching and enjoyed, I appreciate a like on the video. Go ahead and subscribe for future content, and I'll see you guys in the next one.